You have walked into a Chick-fil-A 1,000 times. You have stood in that line that never seems to move. Somehow, it always moves anyway. You have watched a teenager memorize your order. They say, "My pleasure," like they mean it. You have watched the drive-thru clear fast, even at lunch. You have thought, whoever owns this place must be printing money. It feels like the safest bet in fast food. A beloved brand. A line that never shrinks. A fee so low it barely counts as a barrier. Sounds simple. It is not simple. That gap between what it looks like and what it is turns out to matter enormously. Here is the first number. The fee to become a Chick-fil-A operator is $10,000. The average location actually costs far more to build than that. Somewhere between $317,000 and $3.4 million, per the company's own disclosure filings. You do not pay that gap. Someone else does. And that gap is where this story actually starts. You've heard the number before, $10,000. It sounds like a rounding error next to what other chains charge. It sounds almost too easy. That ease is the hook. It gets you thinking about the sandwich, the line, the money. It does not get you thinking about what you're actually being handed in return for that fee. $10,000 is the cheapest door in fast food. McDonald's wants $45,000. Popeyes wants $50,000. Chick-fil-A wants $10,000. But a low price is not the same as an open door. Fewer than 1% of applicants get chosen each year. 60 to 80,000 people apply. Harvard accepts more of its applicants than Chick-fil-A accepts of its. Before you're even considered, you sit through multiple interview rounds. Then comes a background check. Then comes an unpaid trial period inside a working restaurant. The company watches how you behave under pressure, under a rush, under a complaint from an unhappy customer. The company builds the actual restaurant itself. It buys the land, the equipment, the fryers, the drive-through speakers. You do not finance any of it. You do not carry a loan for any of it. Read that again. The company isn't lowering the price of ownership. It's removing ownership from the deal entirely and calling what's left a fee. This is not a price of admission. It's an audition fee. An audition fee doesn't buy the role. It buys the chance to be considered for it. Most applicants pay nothing at all because most applicants never get past the first round. The ones who do pay $10,000 for something else entirely. It's closer to a very well-paid job offer than a business purchase. Think about what a cheap door actually does. In a typical franchise, the barrier to entry is capital. Whoever can raise the money gets a shot, regardless of temperament or skill. Chick-fil-A inverted that filter completely. Almost anyone can afford $10,000, so the company can reject 99 people out of every 100 on character alone. It judges how they hold up during an unpaid trial shift. Instinct matters more than net worth. A cheap door lets the company choose exactly who walks through it. The company also picks the site before it ever picks you. Real estate teams choose the intersection. They negotiate the lease. They commit millions in construction, long before any operator is assigned. Your success is partly decided before you ever apply. A skilled operator in a weak location still hits a ceiling. A weak operator in a great location can look brilliant just by showing up. None of that appears in the recruiting material. The pitch focuses entirely on you, your leadership, your character, your fit, the site, the traffic count, the demographics around it. All of that was locked in long before your interview. You are stepping into someone else's math problem, already mostly solved. So what do you actually sign when you hand over that $10,000? $5,000 of it is gone immediately. It's fully earned by the company the moment you pay it. The other $5,000 becomes a working capital deposit. You must maintain it for as long as you operate. You also agree to something less visible than the money. You agree to work the restaurant full-time, exclusively, for as long as you hold the role. No other businesses, no side ventures, no passive ownership somewhere else while you run this one. The agreement runs year to year, renewed on the company's terms, not yours. You didn't buy in. You signed a leash, and a well-paid leash is still a leash, which raises the obvious question. Paid for what, exactly? Not for a stake in the company, not for a share of the real estate. You're paid generously for showing up every single day and running the operation the company built. That's a real job with real value. It just isn't ownership, no matter what the paperwork calls it. The exclusivity clause is easy to skim past on paper. It is brutal to live inside, day to day. Most operators work well past 50 hours a week. They open personally. They close personally. The model assumes hands-on presence. not remote ownership. There is no version of this where you hire a manager and step back. You cannot collect a check from 3 states away. The restaurant needs you inside it, physically, for as long as the agreement runs. That's a very different proposition than owning a rental property. It's closer to an extremely demanding, extremely well-paid job. It just happens to carry the word operator instead of employee. Candidates deep in the selection process often work inside a restaurant first. That trial period comes before they ever get one of their own. They're evaluated constantly on everything from handling a rush to speaking with a frustrated customer. They earn far less than they will once approved. It functions less like hiring and more like a prolonged residency. The company can end it at any point, for any reason, with no obligation to explain itself. Paid for volume, mostly. The average freestanding Chick-fil-A does over $9.1 million a year. Top performers push past $9.3 million, and that's more than double the average McDonald's unit. Read that again, and Chick-fil-A does it. Closed 1 full day out of 7. Here is where it gets interesting. The Sunday closure doesn't cost the system revenue the way you'd expect. It compresses 6 days of demand into an operation forced to be efficient by design, and the volume numbers show it worked. The mobile app now drives a large share of orders at many locations. Cars queue for food that's already cooking before the driver parks. Catering adds a second channel. Most burger chains never built seriously. Drive-through speed is timed constantly, down to the second, at every location in the system. It determines how much of that $9 million actually clears the window each year. The company tracks it obsessively across every store it runs. All of it stacks onto a 6-day week that outperforms everyone else's 7. This is the best performing floor plan in fast food, and none of the floor is yours. Compare that against the alternative. A comparable investment in almost any other franchise buys you the floor itself. It buys the lease, the fixtures, the sign out front. Here, that same level of operational excellence produces a number on someone else's balance sheet. You built the volume built value. The value landed somewhere you don't have a claim to. Put that number in context. $9.1 million a year sits well above the industry median for quick-service restaurants. It does so with a shorter weekly window than nearly every competitor chasing the same customers. A typical burger chain might do a fraction of that volume across 7 full days. It won't have the brand loyalty that lets Chick-fil-A charge a premium and still fill the lot. Decades of consistent food, famously polite service, and a Sunday closed identity customers respect all arrive preloaded the moment you're approved. You don't have to convince anyone the sandwich is good. That work was already done by a company that also keeps every asset the reputation is attached to. So if the volume is this extraordinary, where does the actual money go once it lands? It goes through a formula. The formula is the real mechanism of this whole business. You pay the company 15% of gross sales, off the top. It's structured as rent for a building you'll never own. Add roughly 3% more for local marketing. The company's total structural take approaches 18%, before profit sharing even applies. Then, from whatever remains after operating costs, the company takes roughly 50% of the pre-tax profit. And here is the trap. Though you won't feel its full weight yet, you're also capped at one restaurant in almost every case. There's no scaling your way past the split. A successful operator can still clear $200,000 to $500,000 in a good year. That's real money, and it's exactly why people stay. Money real enough to buy a house, send kids to college, and retire comfortably, decade after decade, without ever once holding a deed to the restaurant that made it possible. But every dollar flows through a formula you don't control, on a building you'll never hold title to. You're not paying a franchise fee. You're paying rent on your own labor. So what happens the day you stop collecting it? Run the arithmetic on a strong year. $9 million in gross sales. Subtract the 15% rent line. Subtract food cost and labor. Subtract the marketing assessment, insurance, and maintenance. Whatever survives that gauntlet gets split again, roughly in half, with the company. Labor alone eats a large share of that gross figure. A restaurant this size needs a big, trained staff. They work long hours, 6 days a week. Wages have to be steep enough to fight an industry famous for turnover. Food cost fluctuates, with chicken and produce prices the operator can't control. Insurance is set by the size and traffic of the location. Equipment maintenance falls on the operator, even though the operator doesn't own the equipment. Property insurance is negotiated by corporate, but day-to-day liability coverage often still runs through the operator's own business entity. The margin narrows fast before profit sharing even takes its cut. The operator's take, $200,000 to $500,000 in a good year, is genuinely excellent income. It's not, however, business ownership in any sense a banker would recognize. It's a bonus structure layered on top of a job. Call it what it is, a very good bonus structure tied to real performance. It's paid out monthly, month after month for as long as the agreement holds. Plenty of people would take that trade happily, but a bonus structure and a business are not interchangeable words. That's true even when the bonus is large enough to buy a house in cash. This is legal. This is normal. Chick-fil-A owns the real estate. Chick-fil-A owns the equipment. Chick-fil-A owns the brand, the recipe, the lease, and the inventory. It also owns the goodwill you spend years building with regulars who know your name. When you leave, for any reason, the restaurant doesn't become an asset you sell. Read that again. There's no listing, no buyer, no closing table, no payout for the years you put in. The agreement is non-transferable. You cannot will it to your children. You cannot hand it to a partner. Compare that to most other franchise systems. There, a multi-unit operator can build a portfolio over 20 years. They can sell it as a retirement asset worth millions. Chick-fil-A caps you at one restaurant in nearly every case. That entire wealth-building path is closed before you even sign. The unit simply reverts to the company, exactly as if you had never been there. The trapdoor isn't underperformance. It's the calendar. Every year, you re-sign a lease on your own life's work. There is no cliff-edge moment where this becomes obvious. Most operators never test it, because most operators stay for decades without incident. The absence of a crisis is not the same as the absence of a risk. The risk sits quietly in the contract language the whole time, whether or not anything ever forces it into view. Picture two people, running businesses of similar profit for 20 straight years. One owns a multi-unit sandwich franchise outright. She has the real estate, the equipment, and a business worth millions when she sells. The other operates a single, extraordinarily profitable Chick-fil-A for the same 20 years. She earns excellent income the entire time, month after month, year after year. She never once dips below a comfortable living, even in a slow year. When both retire, the first walks away with a fortune, on top of what she already banked. The second walks away with whatever she personally saved. Nothing else, because there was never anything else. Same effort, same decades, radically different endings, built into the structure before either signed anything. Because the exclusivity clause forbids other ventures, an operator's identity narrows to one restaurant for their whole career. 20 years builds deep operational skill. It builds almost no transferable equity, no investor relationships, no portfolio a lender recognizes. Stepping away means starting the next chapter from close to zero, no matter how much money passed through your hands. This isn't a hypothetical designed to scare you. It's the literal, contractual difference between the two ownership models, spelled out in the paperwork both operators sign. One document creates an asset, the other creates an income stream with an expiration date nobody can predict in advance. To understand why the trapdoor exists, go back almost 6 decades. There was a diner in Hapeville, Georgia, called the Dwarf Grill. Truett Cathy ran it. Somewhere in that small kitchen, he developed the pressure-fried chicken sandwich that became the entire company. When Cathy built Chick-fil-A from that diner, he made an unusual choice. He decided the company would keep ownership of every physical asset. Operators would run the restaurants, not buy them. His reasoning, by the company's own account, was selection over speculation. If operators didn't need 6-figure capital to get in, Cathy could pick people for character instead. He could also remove them easily if the fit went wrong. Here is where it gets interesting. That single decision, made decades ago, is why today's operators own nothing tangible, even while running $9 million restaurants. The Sunday closure wasn't rest. It was the first constraint that made every other constraint profitable. Cathy also believed, according to accounts from people who worked with him, that in-house ownership kept operators focused on hospitality. It kept them away from real estate speculation. He wanted people who wanted to run restaurants, not people looking to flip an asset in 5 years. The structure filtered for that intention as much as it filtered for capital. Cathy couldn't have known his ownership model would eventually anchor tens of billions in annual sales, but the underlying logic never changed as the company scaled. The company keeps the deed. The operator keeps the daily grind. The arrangement renews 1 year at a time, indefinitely, for as long as both sides agree. So what happens when this structure collides with a real, contested dispute inside a single restaurant? Look at Hatch Trick Incorporated. It operates 2 Chick-fil-A locations in Austin, Texas. In May of 2026, the Federal Equal Employment Opportunity Commission sued Hatch Trick directly. The case involved a fleet supervisor named Laurel Terode. She observed a Saturday Sabbath and had that schedule honored for roughly 5 months. Then, According to the complaint, she was told her only option was a demotion. Her supervisor role paid $23 an hour, with guaranteed overtime. The driver role offered instead paid $12 an hour, outdoor, physical work. She declined it. On February 27, 2024, her employment ended. And here is the trap this case exposes. When the lawsuit became public, Chick-fil-A's corporate office issued a statement. It said employment decisions are, in its words, solely the responsibility of each individual restaurant owner. Chick-fil-A Incorporated wasn't even named as a defendant. Only the operator was. The statement never disputed the underlying facts. It simply drew a line around itself and stepped back. It left the operator to answer everything in federal court alone. The EASEEK is seeking back pay, damages, reinstatement, and policy changes. All of it aimed at a business the operator doesn't own the walls of. Think about what that means structurally. The operator carries the full legal exposure, the depositions, the legal bills, the reputational damage. The name attached to a federal complaint, the company that owns the building carries none of it. Its name stays clean in the filing. Its brand stays untouched in headlines that specify the franchisee, not the corporation. When it goes wrong, you carry owner-sized risk, wrapped around an employee-sized asset. This isn't a story about whether Hatch-Trick did anything wrong. The lawsuit is still ongoing, and the facts are still contested by both sides. What's not contested is the structure surrounding it. The company that built the restaurant owns every brick of it. It will not be answering for what happened inside those walls. The operator will. That's not a story about one bad operator. It's a story about where liability sits inside a structure where ownership never does. Operators across the system have separately faced lawsuits alleging discrimination, harassment, and wrongful termination. Each one names the individual franchisee, not the parent company. In case after case, the corporate statement lands within days. It uses nearly identical language. Employment decisions belong to the independent restaurant owner. That pattern isn't accidental. It's the same liability architecture Truett Cathy built decades earlier, doing exactly what it was designed to do. It keeps every legal and financial risk contained at the operator level, one restaurant at a time. Whatever the outcome of the Hatch-Trick case, the named operator absorbs the cost of defending it, in time, in legal fees, in reputation, regardless of who is ultimately found responsible. That's the design working exactly as intended. Spread across thousands of restaurants, the risk is diffuse, contained, and cheap for the corporation to manage. Concentrated on one operator, in one restaurant, it can be the single most stressful event of that person's professional life. The same structure produces both outcomes, depending entirely on which side of it you're standing. Every operator who signs the agreement accepts the same exposure. That's true whether or not they ever face a lawsuit personally. You are the name on the door and the name in the complaint. You are never the name on the deed. The company built a system where the upside is capped by a formula. The downside is uncapped and entirely yours. Roughly 98% of operators report satisfaction with the arrangement. That number isn't fake. The income really is strong. The support really is real. Most people who get selected never regret it. Many would encourage their own children to apply for the exact same role. But satisfaction and ownership are not the same thing. This video was never asking whether the job is good. It was asking what, exactly, you were applying for. Applying implies a choice, and for most people, this genuinely is one. Nobody forces anyone into that interview room. Thousands of people compete for the role every single year, fully informed, and would happily do it again. That's worth remembering before this starts to sound like an accusation. It's a description of a structure, not a verdict on the people inside it. The company builds it, owns it, sets the formula, and takes it back on your way out. So what were you ever actually holding? Not a business, not an asset, not something you could sell, will, or leverage into the next one. You were holding a job with unusually good pay, unusually strong support, and an unusually thin legal shield the moment anything went wrong. Every renaming in this video has pointed at the same fact, from a different angle. The audition fee, the leash, the floor that isn't yours, the rent on your own labor, the calendar trapdoor, the constraint disguised as rest, the risk with no ownership underneath it. Say them together, and the shape becomes obvious. Every one of those renamings describes the same trade from a different room in the building. Entry, labor, revenue, cost, exit, history, liability. 7 rooms, 1 house. The deed to the house was never in your name, not after any number of years spent caring for it like your own. None of this makes the arrangement a scam. 98% satisfaction is a real, repeated finding, not a marketing claim. Operators who get selected genuinely tend to love the work. They earn strong incomes. They stay for decades, by choice, not by force. That's exactly what makes the structure worth examining closely, instead of dismissing outright. It isn't a story about people being deceived. It's a story about a company that found a way to keep every asset. It absorbs every dollar of construction risk itself, and it still convinces thousands of talented people to compete fiercely for the privilege of running those assets. That is an extraordinary piece of business design. Very few companies have engineered a pipeline this deep, this loyal, and this cheap to maintain. The genius, if that's the right word, is in what the company doesn't have to offer. No equity dilution, no messy multi-generational ownership disputes, no portfolio operator quietly building leverage against corporate, just a renewable one-year agreement with someone who auditioned hard to get it. That person knows exactly how many people are waiting to replace them. Consider the number one more time, slowly. $10,000, less than the cost of a used car. It buys entry into a selection process harder than getting into Harvard. It buys a role that can pay $500,000 a year at its best. It's attached to an asset you are contractually guaranteed to never own, no matter how long you run it, no matter how well you run it. Every other franchise system on Earth asks for more money, and it offers more in return. A deed, a lease in your name, something to sell when you're finished. Chick-fil-A asks for less money and keeps everything permanently. That's true by design, from the day you sign to the day you leave. That trade isn't automatically a bad one. For the right person, the income, the support, and the built-in reputation can outweigh the missing equity, especially against the very real risk of sinking a life savings into a franchise that fails outright. But it is a trade, and trades deserve to be understood in full before anyone signs the audition fee line. You were never looking at a franchise. You were looking at the best compensated management position in America, dressed on paper as ownership. The next time that drive-through line clears in under 5 minutes, notice something. You'll know exactly whose asset just got a little more valuable. It was never going to be the person running the window. That's not a tragedy. It's an arrangement. Negotiated openly, entered into by choice, by people who mostly stay satisfied for decades. But it is worth naming plainly. The next time someone tells you the entry fee is only $10,000, the fee was never the real price. The real price was everything you agreed not to own. It was signed away quietly. In exchange, a paycheck bigger than almost anyone expects on their very first day.